Namaskar viewers, hello and welcome to Sansad TV. I'm Tina Jha, you're watching Perspective. On the show today, we are going to talk about the Reserve Bank of India's Financial Stability Report, which was released recently. Among the key highlights of the 26th issue of the report, the central bank states that the global economy is facing formidable headwinds with recessionary risks looming large. The interplay of multiple shocks has resulted in tightened financial conditions and heightened volatility in financial markets. The Indian economy is confronting strong global headwinds, yet sound macroeconomic fundamentals and healthy financial and non-financial sector balance sheets are providing strength and resilience and engendering financial system stability. The floating demand of bank credit as well as early signs of investment cycle revival are benefiting from the improved asset quality, return to profitability, also strong capital and liquidity buffers of scheduled commercial banks. The gross non-performing ratio, the GNPA of scheduled commercial banks, fell to a 7-year low of 5% in September 2022, while the net non-performing assets, the NNPA ratio, stood at a 10-year low of 1.3%, whereas private banks' NNPA ratio was below 1%. So we'll analyze each of these aspects mentioned in the report with distinguished panelists who are joining us on the program today. Besides, we'll also look at some of the concerns and risks cited by the central bank, as well as the road ahead for the Indian economy. And for this, let me welcome on this edition of Perspective, Dr. Ashok K. Nag, former advisor, Reserve Bank of India, Professor Charan Singh, CEO, IGRO Foundation, and Mr. Dilip Chinoy, former Secretary General, FICCI. Thank you, gentlemen, for joining me on this edition of Perspective. So before we get into sector-specific questions, let's get an overview, universal view on the RBI report. And let me begin with you, Mr. Nag. What is the big takeaway from the RBI's Financial Stability Report this time?
The RBI Financial Stability Report, one thing very important, which is a flag there, that despite, as you told, the headwind from the global economy, it seems that the not only RBI, also RBI conducted what we call a survey, systematic risk survey, and the survey respondents also, they said that Indian macroeconomic is quite good, and in the next 1 year they don't face any kind of a major kind of a problem. So this is so far as the RBI's take on that. Then of course this is a stability indicator. There are two kind of indicators as there: banking stability indicator. Then it's also the risk stress indicators, and all the detailed calculations. Everything has been done, and it shows that we are in a good shape so far as that. If we can manage the headwinds which are coming from the globally appropriately or properly, unless something happens. Only thing I can tell you these things, that the problem with all the exercises which have been done by RBI, which is a very professional, quite advanced, and despite that, I just wanted to remind you that in 2006, in Economist, and it was come in the Alan Ginsberg's paper, that it says that market capitalism-based economy is doing its job very well. December 2006, and Ginsberg told in the paper, all the forecasts are coming very good, but you know what happened in 2007. So we should be very, the exercises of those things which are happening, yes, we should be doing that, we should be careful about that, but there are certain issues which I come later on these exercises of the indicators and stresses.
Sure, Professor Singh, so lots of positives that have been cited in the report, but at the same time, cautious optimism is the way to go. Do you agree?
Yeah. Only thing is that, see, financial crisis, when it happens, whatever forecast you do, unless you can take quick action, quick kind of response to that, may not be possible for that to overcome this. There will be crisis. There will be crisis.
Certainly.
There is no doubt about it.
We'll come to the challenges in just a bit. But Professor Singh, that question was for you. How do you look at the report first? Of course, your response to the big highlights. And the fact that cautious optimism is something that we should tread on. That's the way to go ahead for India?
I think Dr. Nag has hit the nail in the head. He's very right. In 2006, 2007, who knew about the 2008? It was only a few countries like India which had been telling the world, and if we are a poor country, emerging country, they are advanced countries, we hardly account for 1% of world GDP, they account for 20% of world GDP, We were telling them these derivative products are very, very difficult things. We should not go near them. And the world was telling India, you guys are so reluctant and you are not risk takers. Don't you know derivative products are the modern financial engineering innovations? And we were really shy of it. And nobody knew that these derivative products could be so harmful, both the mortgage-backed and asset-backed securities. If you look at 2008, that's exactly what happened. They bombed and nobody could recover for more than a decade. And then, of course, COVID happened and we were already vulnerable, not recovering. And then, of course, the second wave of high inflation, Ukraine-Russia war happened, and we were still not able to recover. So the point that Professor Nag is making is that most of these models are backward-looking in the sense they use the data, the stress testing, everything is backward looking. One can conduct surveys, and he mentioned about one of the surveys, and that survey is, of course, forward looking, taking sentiments of the people and seeing where we are and what are we doing. Now, if you look at the risks to the financial stability, which has been beautifully explained in this report, but the Reserve Bank has been explaining about it even earlier. There is volatility in the exchange rate, the US dollar becoming very hard and strong, and there is in commodity prices, crude prices are there, food prices are there. There's a global slowdown expected because interest rates are rising sky high. Different situation. But if you look at the situation in our own country, and the report has done stress test, and they've clearly shown in the stress test that we are, yes, there could be a problem here and there, but in large, generally, a very robust banking system we have. As you just mentioned in your introduction, the gross NPAs are down to just 5%, which is superb. And the net NPAs, where provisioning everything is done, is around 1.3%, which for a decade we didn't achieve that level. So these are very, very good figures. They show that we have the resilience. They also show that we have made provisions. To me, the best thing they show is that the Indian banking system has been very conservative, has prepared itself very well, and despite COVID, they are well prepared. Their credit growth is good, deposit growth is good. Now, looking ahead, there can be scenarios which could be really dangerous. And one of the two things which I can mention now, we can take it later. One of it is if the global growth rate is going to scale down, because they are aggressively raising the interest rates, our export markets can get impacted. That is one. Secondly, because the US dollar is strengthening against all currencies, Indian currency has depreciated not as much as many other countries, but has depreciated nevertheless. That could make imports a little more expensive. Now, that is the reason that our current account deficit has gone beyond our tolerance limit of 3% of GDP. It is hovering around 4.4% of GDP. So there could be some tension, some problems that can come our way. But if you look from the financial stability angle, and the report has spoken about the commercial banks, non-banking finance companies. Overall, if you look at the financial stability angle, I think India is amongst the best countries in the world and has, because the growth rate is very strong, it has the wherewithal to withstand any crisis. 2023 is going to be a litmus test for the whole world, including India. And as I look at the financial system, I think we'll be able to withstand.
And that's something that the RBI has also indicated, Mr. Chinoy, in its report, that despite 2022 being a good year for India because we've been resilient, there have been several factors which have helped us. So help us and our viewers understand first what have been the biggest strengths for the Indian economy behind our financial systems actually working so smoothly despite the global shocks to begin with. And most importantly, now looking ahead, when the 2023 year is going to be very, very challenging for us, the spillover that it could have on the Indian economy.
So, Tina, I think both Ms. Nag and Professor Charan Singh have covered the report extensively, but just to target your question, for many years, for the last 3 to 4 years, industry and the whole investment sector was faced by a twin balance sheet problem, which is commonly known as the twin balance sheet problem, where industry had huge debt. The banks had huge exposure to industry and the NPA levels were high, and therefore the banks faced reluctance to lend, and there was a whole challenge of recapitalization and strengthening the banking system. What this 26th report actually points out is now that is hopefully behind us, and therefore, as Professor Charan Singh mentioned, that you mentioned in your opening statement, that the net NPAs have declined, the lowest in many years, and there is enough money with the bank to lend for development programs. And also, very interestingly, one of the challenges in the past was that the private sector investment was not happening. And in this report, they're showing signs of investment actually returning, and investment, the private investment actually making a big thing going forward. Now they have they have cited these different challenges, and in addition to the ones that Professor Charan Singh mentioned, which are rising borrowing costs, the debt distress which is there, or the inflation, the geopolitical situation, the volatility of the commodity prices, and the currency depreciation. There is also the issue of capital outflows that comes with the currency depreciation and rising interest rates outside. So, what the report says very nicely is that the Indian system has been able to so far deal with this in a manner and make it, kind of stable for firms operating in India not to be greatly impacted by all these global developments. Yes, there is the challenge of falling exports, right? And those companies that are very hugely export dependent need to either increase their current share of market, or find different avenues to deal with the export surplus that they may have because of the shrinking market. But it also says very clearly that the domestic scenario would be fairly robust going forward, and we are in a way insulated from some of the negative impacts and challenges because of the robust and stable financial system. And I think the report also says, going forward, that in the challenging environment, it will require a kind of a safeguarding the domestic economy and the financial system through actions that mitigate all of these vulnerabilities that have been stated and help smooth financial market adjustment. So it shows that they would be sensitive and and alive to any quick changes that they need to make to ensure that the domestic economy is robust and that we have access to finance here. Of course, the other negatives that they talked about, I'm sure we'll talk about that a bit later.
Dr. Nag, coming back to you and taking on from what Dr. Chenoy said, that, most of our domestic economy, most of the sectors in our economy have managed to remain insulated, and which has helped us recover faster than anticipated. But the question is, most of these external shocks, the global headwinds that we've been talking about, continuing to persist. And as, Professor Singh said, 2023 is going to be a litmus test for the global economy. The question is, for how long can the Indian economy and these sectors remain insulated? Point number one. And how well braced are we in dealing with this global storm to ensure that it does not land on the Indian shore?
Before that, I would like to point out one thing, which is a fundamental thing in finance, is that risk and returns are always, if you want more return, you have to take more risk. One of the luckiest thing in India had, it was delinked much from the global economy to a large extent as compared to its counterparts. For example, today, China is much more globally linked as compared to India today. Okay, it's export-import. And China will face much bigger kind of shocks because of what can happen in the world market rather than India, because India is still much less integrated with the world market. That is the benefit also that may leak out to the lower kind of a growth rate. That's the one thing. So point is that this particular, your question was on the, can you just tell me the question? I just forgot the question.
Sure. The aspect that with most of the global, headwinds and external shocks that we've been speaking about.
Global headwinds will have impact, as Dr. Charan Singh has told, through your currency kind of a cost of your inputs which are coming from abroad and your thing. But it is one thing is that we must understand that thanks to Reserve Bank of India's, prudential policy, we have still got a sufficient kind of a reserves in our A, which are built up over time to at least we hope that if it is not a very big crisis in a 1 year crisis, we should be able to tide over. That is very good thing. So second thing is that global crisis can happen in a very different way if you have lot of kind of decisions in those markets, because our one of the major export is our service, and we get remittances is a big kind of things that if that gets affected because of the global crisis in the particularly in oil sector, I think it may affect our kind of a thing. But it is true that we have built up enough kind of reserves to tide over at least 1 or 2 years of any big crisis. If it goes beyond that, it is anybody's guess. So that way we are good. But one thing is that, the problem of this stress testing or the crisis kind of these things is that and as Dr. Charan Singh told, the derivative, it is because, what happens, the contagion effect. Derivative is a product which is a very much prone to a contagion effect. If one kind defaults, it causes a spillover. To some extent, the contagion analysis which has been done in this particular document, I think that is little bit more optimistic. I don't know how it has been calculated, because it has been written that the largest kind of I think the bank, if it has a fails, then it is only 2% or 2% kind of a thing, which I can't believe it. Okay, I don't know why. Second thing is that the main problem of any kind of a man's disease, if you have multiple organs, if single organ fails, you can really manage it. When multiple organ completely fails, it is very difficult for a doctor to really address this issue. That is the main issue. I think the contagion effect has not been really done, very seriously done, as it has been done in other parts of the this document, which has been very, very professionally done. But this contagion effect is difficult to do it. I'm not saying that it's possible. Second thing is that any kind of a linear description of the model of the economy is not going to capture the real kind of a problems in the economy. That is my point. So I think we have to go beyond because if you read the document, most of your models are linear, which may not actually, we have to go beyond that. That's my point.
Absolutely. Professor Singh, talking about the other aspect, and this relates to the concerns that the RBI has stated in its report, is about the states' rising subsidies. Now, the RBI, and this is something that we've discussed earlier on in the program as well, but now it being incorporated in the RBI document makes it all the more important. The RBI says it is going to hinder spending on development. Now, if you could help us and our viewers understand clearly how big the problem is, and particularly with states now, resorting to more and more subsidies, how dreadful is this going to be for the economy?
Before that, let me just share some thought with you. When we speak about contagion, what do you understand from contagion? For your views, it will help you. Let me give you a simple example. Look at the news item that COVID has come back in China. You must have noticed suddenly everybody has started putting masks in Delhi. What happened? It has yet not come to Delhi or India, but people have suddenly become cautious and started putting on a mask. If somebody comes to your room, entering, coughing, your first reaction is, oh God, I'm gone, right? So this is exactly what happens in contagion. Something is happening in America, something is happening in Europe, and these are important countries. They account for 20% of the world GDP. America itself, America, Europe put together about 43% of world GDP. If something is happening there, it's going to travel. But one of the channels through which problems can travel is, of course, as I mentioned, if they slow down, our exports go down. But one of the obvious channels is also the confidence channel. People nowadays, the confidence channel plays a very important role. And therefore, when we speak about the linear models, we are still depending on the data sets which are previous. If you look at the survey, which Professor Nag was mentioning, and the report has given all beautiful breakup of what's going to happen on macro, what's going to happen on geopolitical, all those things, these are still judgmental and not very sure. So therefore, I mentioned in 2023, because there is such uneven reaction to all the things that have piled up since the Lehman Brothers, since COVID, Since the last Russia-Ukraine war, each country is reacting differently, and we do not know how it's going to precipitate and hit the global market. If you look at total trade to GDP ratios, China about 20%, India about 20%, America about 11%, huge. So that contagion would travel, but what speed will it travel? When will it hit us? How severely it will hit us? We don't know.
Right.
While they are raising their interest rates to protect their inflation, we are also raising our interest rates so that the capital does not outflow. Other countries are doing similarly. The depreciation of the currencies has moved unevenly across the world. So it's a very uncertain 2023. In this very uncertain 2023, how have we built our reserves? We have done good amount of foreign exchange reserves. They're already around, I think, 560 billion, about 7 to 8 months of import cover. That is very good. But we also have robust capital adequacy ratios in our banks. Our NPAs, the provisioning is very strong. So therefore, I'm of the view, while the world will shiver, we are going to go strong and steady. Now coming to the question of subsidies. Now, one thing is very clear. The Reserve Bank had recently come out with a study which had dedicated itself to subsidies in a few states, and it had said that these states are very vulnerable because the amount of subsidies that they are giving, or call it the freebies, mainly the freebies, are so high that these states cannot afford because their revenue deficits are high, their debt to GDP indicators are high, their gross fiscal deficits are very high. Amongst those states, Punjab was one of the states which was very high on the fiscal indicators. Now, the problem is that if the state finances are not robust enough and the state finances are not strong, then the central government has additional headache on its hand to tackle, to provide support to these states. While on the one hand, the whole country is facing the COVID crisis, the Russia-Ukraine war implications in terms of high oil prices, high wheat prices, and all those other implications, fertilizers and other metals, you suddenly have another additional dimension open up that one of the states is becoming vulnerable. Please remember, all the center and the states borrow from the markets. They borrow on the state development loans. And they suddenly, if the state is not doing well, that gets impacted. Ratings get impacted of the states. So therefore, it's very important that these states, during this difficult time, maintain a steady and a strong balance sheet of their own. That means the revenue deficits of the state, the debt GDP indicators, gross fiscal deficit of the states, capital expenditure of the states should be high enough so that the states are strong. And therefore, I think the center is right, the RBI is right. RBI as an advisor to various governments, RBI as a manager to debt instruments is right when it advises the central and state governments, saying that the state governments are raising their subsidies beyond what they can afford. So I think this cautionary note by the RBI is welcome.
Okay, Mr. Chinoy, apart from the subsidies and the concerns that the RBI has stated on this particular aspect, two other areas that it speaks about and which concerns us extremely well in today's scenario is the crypto assets and the cyber risks and financial stability. So on both these aspects, the RBI calls for a common approach to address potential risks. How important is it going to be? What is the kind of framework that is required to ensure that we have a robust system in place first?
So I think, Tina, the whole area of crypto assets and is currently viewed differently amongst many, many different countries. The RBI has come out with a very strong statement, and also in the report made an observation that perhaps we should it can actually destabilize the entire economy going forward. But in the budget, the finance minister actually laid out a model for taxation of digital assets, which are really the crypto assets there. And I think as a country, we need to focus on 2 or 3 things to be able to address these issues. I mean, the issue is that you need a bit of a regulatory framework.
Right.
Saying that we're not going to create any regulatory framework. The regulatory framework could be, in one extreme, saying that it's not allowed then there's no question of taxation or whatever it is, to another extent of saying, okay, this is the framework that will operate. So, many experts have talked about the need for putting in a regulatory framework for crypto assets, or even for, other assets which are digital assets, whether they're fungible tokens or, other assets, not necessarily cryptocurrency. So I think first, as a country, we need to actually start the debate. Please understand that we're going to get into election cycle. So maybe it may not be possible to do something legislatively, but we need to actually start the process to develop a whole robust regulatory framework for this area. The second is, as far as the cyber security and the cyber issue attacks, even the own RBI digital currency kind of coming in, this is an area of great concern. We recently saw, the medical system being attacked, and while there is, a cyber security watchdog and the certification which is there, we need to now start a huge national campaign on educating different segments of society on the need to follow simple cybersecurity norms. It is happening in bits and pieces, but we need a national effort, and also the different levels of government institutions, corporations, organizations. We need to develop a very robust framework for this.
Clearly.
And start a communication exercise which we can actually insulate ourselves against external hackers, against cybercrime, against all of these cyber security attacks. Because if you don't do that, then we are leaving ourselves vulnerable, because the strongest or the weakest link in the chain will be attacked, and then you'll find ways to get data and go forward.
Clearly,
so
and something that we saw at our premier medical health institution just a few weeks ago, what happened at the All India Institute of Medical Sciences is a lesson for all of us, and we have to ensure that the manner and the pace at which we are transforming digitally, we also have to have a robust framework which keeps us safe and secure. But with that, I'll have to wind up the program. Time is running out. Thank you, gentlemen, for joining me on this edition of Perspective and sharing your thoughts with us and our viewers on this very, very important subject, the RBI's Financial Stability Report. And thank you, viewers, very much for your time as well. I'll see you same time tomorrow. Take good care of yourselves and keep watching Sansad TV.